Welcome to the live video of the Gamma Optimizer room. As usual, the first question is if you can hear sound and if you can see the videos. If you can type on the live chat, it will be fantastic. So I'll wait for your feedback. I wonder what will be the delay. Okay, no takers yet. Any sound? Can you hear sound? Just checking before starting. Okay, what about now? Can you hear now? No, still no sound. Okay, I guess there is some problem with my other microphone. So anyway, so we are ready to start. Thank you for the feedback, and I hope that there is video. so welcome again to the live video for this Friday. We definitely had a very interesting week. So let's start with the close positions. This week we didn't have any trades because our ultra neural net kept us on the right side, and we were completely flat before the week, and it turned out to be actually good. No, so from that in that sense, I think we are okay. It's better to be flat than to be on the wrong side of the market. So that's good. Now let's look at the market regime. The market regime is very interesting. We are in a very tricky point in the market. The GT level, when I prepared the slides, was around 3,882, and we are below it, so that means that we are short gamma. So we are short gamma. We flipped short gamma actually really early on the week, on Monday, I think, or we flipped short gamma as expected. So we are short gamma, although not by much. No, we are only 50 points away from it. The market seems to be able to remain a little close to where the GT level is. The imbalance to the upside is around for almost 5 billion of buying, and down is about 17 billion of selling. So you can see that moves down they are kind of amplified, because if the market moves 1% down, there needs to be some significant selling. So that's what we saw this morning. We saw like a big dip and then lots of buying, and now it's kind of a little stable. So it has been a very interesting week because short gamma regimes are very active, are, are really frantic, and you saw that we have tons of volatility. Interestingly enough, for those of you that were here last week, I was kind of expecting an organic flip, and we got it. No, we got the organic flip on Monday. We'll see. We need to start seeing the GT level to start coming down again in to get an organic flip long gamma. But so far it has been very stable around 3,880 and 90 has been around that area. So let's see if it starts coming down in the next few sessions. So for now we are short gamma. For now, high volatility is expected in the near term. Also, downside action is the name of the game. It tends to dominate in the near term. In terms of volatility, oh, by the way, you can ask questions at any time. I think this particular stream has less latency, so I will be able to read your questions sooner. I will not have to wait that long to read your questions. So any moment that you want to ask any questions that you have, I'll be more than happy to answer them. So realized variance in SPX for the last month, it hasn't changed that much from last week. Even with the crazy action this week, it remains pretty stable around 15.84, 16%. It's not that bad. However, the realized variance for the last 5 sessions is gigantic, 22.89. And that's, of course, related to what we saw now, the crazy action that we saw at the beginning of the week. So it was a hectic week, mostly intraday. That's the most interesting thing. Most of the variance happened intraday, and yet the market managed to close not that far, with the exception of yesterday. Yesterday was the first time the market actually closed really far from the previous close. And this was a prime example of what happens when the market flips short gamma. Short gamma is always like this. Short gamma is lots of activity, lots of moves, lots of points, like 100 points down, 90 points up. It is crazy. So it must be a paradise for those of you that are day traders. If you like to trade during the day, that's fantastic because you get these gigantic ranges. So far, the craziness of this week hasn't permeated yet SPX. VIX is around 25, 26, so there is some premium. I forgot to comment about the premium. There is still a decent amount of variance risk premium in the market, and that's why we need to figure out ways to extract it. Now, we need to keep focusing on strategies that extract that risk premium, because options are incredibly overpriced right now, and it hasn't changed. Now, we have been waiting for the mythical collapse of volatility for a while, and it's not happening. So let's look at the term structure of SPX options. If we ignore the data point, I don't understand why I have noise on that expiration. That's not really real, but I have noise there. But let's focus on the blue line and the red lines. The blue line is options when I generated the slide, real-time options, and the red line is from last week. Each data point is basically the VIX computation for each expiration, including like the 0 point is today, and then as time moves out, this is the distance to expiration in days. So you can see that we're inverted. We haven't had an inversion in quite a while, and now we have an inversion in the next 2 weeks. So dealers are kind of being really careful right now. They, instead of just rising the term structure as a whole, they are just rising the near term, and you can see it. You can see in the red lines, you can see we have a nice upward slope at that time, and now it's inverted, and that reflects expectations of extra volatility for the very, very near term. What is it? I don't know. I don't know what they are seeing. Well, I mean, they are seeing the short gamma regime and the craziness, but other than that, a more fundamental reason, I don't see it yet. In any way, the curve looks really flat going out 50 days, 100 days, 150 days, but it remains very, very elevated. You notice that all those data points are above the 25% level, and VIX remains at 25 too, and it has been a constant for the past year. For the past year, we have seen VIX above 20 all the time. I have a question. Isn't that still high all the way out, 30? Yeah. Well, I mean, yeah, the big all the way out 30 is extremely high. Volatility is very high in general. And it hasn't, we have been waiting for a collapse of implied volatility, but clearly option prices are not coming down, and it is because option dealers are not willing to sell them cheap. And to me, is a reflection of expectations of high volatility going forward a whole year, no more. It seems that 2021 has been discounted for some reason as a very uncertain year. But it is even worse in the near term. The near term is even worse. So this ties up with a recommendation in the room. I have lots of people that have been really tempted at shorting volatility products like VIX futures, or VXX, now the ETF. And I don't think that trade works at all. I don't think that trade has worked in a whole year. I think shorting volatility outright, shorting implied volatility, is not the way to go. I think the way to go is to do the differential shorting, implied versus realized. So when a relative trade works better because, yeah, options are overpriced. Realized variance hasn't been as high as VIX is predicting. VIX has been predicting consistently 20, 25s, and yet we only have 15s. No, if you look at, we only have 15s per month, and it has been very consistent. There has been always more than 1,000 basis points of difference between what VIX predicts and what actually happens. So there are still lots of opportunities shorting the difference between the two, but not shorting VIX itself. Okay, so that's in terms of the term structure. Let's look at realized variance. Again, the realized variance this is intraday realized variance. It's very different to the normal realized variance that you see. Most of the time you see close to close realized variance in the charts. This is not close to close, this is intraday. This is a measure from 9:30 in the morning to 5 p.m. And you can see here that towards recently it has gone crazy. We had some period of calm that lasted like 2 weeks or 3, and then we are spiking again. And initially VIX didn't react too much. VIX is the red line. You can see that VIX didn't react much to it. But then yesterday it started reacting. Finally it started reacting. And now dealers are starting to price on uncertainty there. But from the point of view of realized variance, this doesn't look good. And for those of you that are new to this, remember that we use realized variance as a proxy for liquidity. Okay, so to me, the blue line represents liquidity. Values below 10% is ample liquidity in the market. Values above 10% show liquidity stresses in the market. Well, and you can see from the crash that there was no liquidity at all. No, the thing went all the way almost to 80. But now we are above 20, and that's not good. No, that's not really good. At least today we are seeing some calm, but liquidity has been really elusive in this week. Intraday, no, it has been really elusive. It disappears very quickly, and I think we have a liquidity issue in the basket. So that's something that we need to keep an eye on, because that's not good. If liquidity is not good, the market cannot recover. No, we want to see, in a healthy market, we want to see healthy amounts of liquidity. And right now we are not seeing it. So we need to see a nice period of a nice stable period. You notice that since January 2021, the times we have been below 10 are very few. In between, the realized variance has been really unstable this year, and that shows that we are having liquidity problems this year, compared with, for instance, the last months of 2020, where liquidity was more stable. So something is cooking. I don't like it. That's kind of the the takeaway of this particular chart. In terms of ambiguity, ambiguity is not a factor. No, it's really not a factor. It hasn't been a factor this time. Ambiguity remains very stable. It's below 0.2. Again, for those of you that are new to this presentation, ambiguity is a statistical indicator that measures a very specific type of uncertainty. It's extremely related to VIX, but it's a methodology that is complementary of VIX. In fact, it was invented by the same guy that invented VIX. So ambiguity is below 0.2, and it's not a factor, although it seems to be starting to rise again. And the next time it goes above 0.2, I'll let you guys know. But for now, there is not much to report on the ambiguity space. Whatever happened, the mini correction we got this week is not related to ambiguity. There are other reasons for the correction. Whatever the reasons are not ambiguity related. So not much to comment here. Any questions? Okay, no questions. So what is the trade plan? The trade plan is very simple. We are back at the same thing. We see VIX really overpriced, and that means that we saw the whole curve, the whole curve overpriced for the S&P 500 options. Therefore, we are going to do the variance risk premium trades. We continue extracting variance risk premium. This time the change is for 3 sessions. We usually extract it for 5. I am switching to 3. I was planning on switching to 3 on Monday, but we haven't had a signal for those trades, and still we don't have a signal for those trades. So that's why I haven't done any, but it's just because there is no edge at this particular juncture. No, so and just one general commentary is that Ultra has been really good, and it has really kept us on the right side, and we avoided trouble. For instance, this week I was completely flat, basically, and I enjoy being flat. I just watch all the craziness, and nothing happened to my account, no, so that was good. I have a couple questions. What can cause lack of liquidity other than absence of enough buyers or sellers? Well, you remember that that's not how the market works. No, the market really doesn't have, well, buyers and sellers are just one part of the market, but it's not enough to sustain a market to having buyers and sellers. You have to have liquidity providers or market makers, no? So I think the issue is that we don't have enough market makers anymore. I think there's only like 2 market makers, and then we switched to a complete different model. And that's something that you can see with Robinhood, no? Robinhood doesn't use a market maker model. Robinhood basically just sells order flow to some kind of dark pools. And that's pretty much what everyone is doing in TD Ameritrade, Interactive Brokers. Everyone is selling order flow to dark pools. Okay, so the dark pools are the liquidity providers right now. There are no market makers anymore. Like all of the retail orders are routed through dark pools. And those dark pools provide liquidity whenever they want. Now, if they don't want to provide liquidity, they don't do it. They are not mandated by regulation. They are not mandated by the exchanges. All of this retail trading is happening outside the exchange. So they are not subject to any of those regulations or protections. And I think that's one of the reasons that liquidity has been so fickle, is that we don't have a regulatory framework to guarantee that liquidity is present all the time. Of course, providing liquidity to the upside is the easiest thing to do, but whenever the going gets rough, as they say, the liquidity disappears, and we have seen it. It just magically disappears. The dark pools don't want to make markets anymore. The high-frequency trading office don't want to trade. They turn off the algorithms. So that's kind of what is happening there. So I have a. No, dark pools have not fronts to anything. I mean, anyone can start. We could start a dark pool if we wanted to. You know, a dark pool is basically a private exchange. So because it's private, it's not subject to any regulation. The only time it's subject to regulation is they have some regulatory report requirements. They have to report the trades. They have to do a couple of stuff. But in fact, a dark pool is just a private exchange. It's not a public exchange. So when the orders are sent to these guys, to Citadel, for instance, they don't have to do anything. They can do whatever they want with your order, and the order is internalized, and they cross your order against something in the market. That's how they make money, no? The reason they pay all these millions of dollars to Robinhood is so they can screw you out of your trade. They are crossing your trade versus a public trade in the market, or versus a trade in another dark pools, and they are making a few cents here and there, and in millions of trades that quickly accumulates. Okay, it's a very simple business model. It's not quite market maker business model. I have a question. Can you explain a Freddy trade? Oh, I'll explain it in a little bit. And I have another one. Can you discuss win-loss stats for TIR BRP20? Yes, I will, just in a few seconds. Okay, so let's switch to the variance center for a little bit. Okay, so now we are in the variance center. This is what is happening today. I'll come back to the questions, don't worry. This is what is happening today. So for those of you that are not familiar, the variance center tracks the GT level, which is the neutrality level for options dealers. And right now it came down a little bit. It's at 3,878. And that's the level when the market flips from short gamma to long gamma. So right now we are short gamma, and you can see that we are short gamma in the imbalance. If the market moves 1%, then dealers need to hedge about 12 billion buying. They have to buy the basket in a notional amount of 12 billion. And if the market moves down 1%, they need to sell around 22 billion notional to remain neutral. So this kind of hedging is short gamma hedging. So notice that if the market moves up, there is massive buying, then it accelerates the move upside. And if the market moves down, there is massive selling, so it accelerates the move down. That's why short gamma has so much volatility. And you can see the realized variance is very elevated at 23.64 since the open. But the one that is faster, the realized variance for the last half an hour has moved even higher. It was around 38 at some point and then coming down, and now again it's starting to get a little frisky. But it's still high. In terms of these amounts of money of gamma imbalance can be broken by strikes, and you notice that the strike that is contributing more short gamma is the 3,800 strike. Contributes a lot of hedging acceleration down. 3,825 not much, 3,850 not much. So 3,800 is kind of critical. If the market starts to move organically towards that level, it will be quickly accelerated towards it. No? And kurtosis is tremendously elevated right now. Kurtosis is a measure of randomness in the market. For those of you familiar with probabilistic distributions, you know that perfect Gaussian distribution, normal distribution, has kurtosis of 3. So right now kurtosis is very elevated, which means that the moves in the market are very deliberate. People are either buying or selling big chunks beyond just randomness. There are some deliberate intent to market action today. So today is a day that is not random. So don't assume randomness on the drift. Whatever you're seeing today has a lot of intent. Okay, now let's come back to Ultra and discuss a couple of things from Ultra. First of all, Ultra has been fantastic. This prediction was made last week on Friday, and Ultra was predicting a down Friday today. It was predicting a very heavy negative mean. In fact, it was predicting that we will close below 3,867 today, like a high odds, and yes, and we are below that level. It's actually very good. And notice that Ultra has been pessimistic pretty much for next week, for all of next week. And just in the last 2 sessions, it's starting to change a little bit. The predicted mean of the distribution is improving, but it's still negative. So it is negative. We have a positive signal for the VRP extraction signal, which is it's basically 19.98. It's right there. If it flips to 20, this trade doesn't work. So we'll see how it looks like at 4 p.m. Okay, now answering the questions. What is the Freddy trade? The Freddy is one of our members, and he has a very interesting trade. It's a directional trade where he goes long the market or goes short the market. For instance, he is short since a long time ago. His short is making lots of money. And what he does, this strategy is not mine, it's from him, all credit to him, okay? So he takes the mean. Remember, those are predicted means in the future. Those are not values in the past. All these values are future values. So he takes the 5 future predictions and average them. And he looks at the sign. Is the sign negative? So then the market has a negative bias. And he only trades with the bias changes sign. So right now the bias is negative, and it has been negative for a while, so he's short. The moment this average flips to a positive sign, he closes the short, he covers the short, and then he flips long. And that's it. It's very simple. Now, so what he's doing is he's using Ultra as a trend predictor. He's trying to predict the trend of the market by averaging the predicted means. He's trying to create a system that predicts a trend, which is, I think, is very original. And I think the system works really well. I think it really works really well. In terms of the statistics for VRP3, I already posted them. They have been posted in the room. They were posted a while ago. Let's see. I can look for them quickly right here. I think they were posted last week. If you miss it, let me see. It's around here. Just a second, because those are comments about okay. This is the one. So this strategy is actually very good. If you go to the link there, you can compute the odds. I think the winning rate is around 95% winning rate. And negative signs means winnings. So this strategy is the this is the 5 session. This is the 3 session. This is the 3 session one. So it's a very good strategy. It has won most of the time. Pretty much the only times he had last year that he lost was in June, in October, and in February of last year. And it has around 95%. We can discuss more about this strategy in the room, but it's a very good strategy. I think the VRP20 with 3 sessions is a very good strategy. It has a fantastic edge because Ultra has a good edge, and the strategy itself has a natural edge. No, so you have a natural edge on the options are already overpriced, so you get even more. So not that bad. And so if you want more information, I'm happy to discuss on the room. Any questions about this, about Ultra and the predictions of Ultra? Because I guess we arrive at the end of the video, just at the almost just 4 minutes before the end. So it was a quick meeting. To me, the general take is, I keep repeating this all the time, don't catch a falling knife, folks. Don't try to counter-trend this. Don't get too cute trying to find a bottom and going long just because of the sake of going long. It's not a good strategy. I will say wait at least until Ultra starts to be a little more optimistic, and then you could start, like trying the waters, testing the waters, but I will not go massively long at this time. I have a question. Will you include the full distribution for the 3A signals or just a simple VRP widget? My plan is the widget. I don't plan to share it's a proprietary net. I will not share it publicly. For the Friday trade, can you use SPY? Yes, I mean, it's a directional trade, so you could use basically any instrument that has a strong correlation with the S&P 500. I think the futures are good in the sense that they provide a lot of leverage. So you can leverage the results, but yes, you could do it with SPY. SPY, I don't think provides any leverage other than the normal margin leverage. So, but you can use it with any instrument that you want, even with the basket itself, or just a few members of the basket. But it seems to be a decent strategy, the Freddy one. Okay, folks, that's it for today. Again, thank you very much for attending. Don't worry, this will pass, but by the way, until Ultra starts to become optimistic before trying to go aggressively long in the market. I hope you have a great weekend, and as usual, if you have any questions, just contact me in the room and send me a message there or send me a private message. Again, thank you very much. Have a great weekend. Bye-bye.